Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face, and I hope you're catching pips as usual. Pips of Persia here with probably the most important video that I have ever recorded for this channel, especially for those who genuinely want to make it in this industry and genuinely want to become a full-time trader. Today, we are going to be speaking about risk management, a full guide on how to manage your risk in trading. So this video is not going to be your typical risk management video where we're going to go through the very basics. I'm actually going to dive deep into advanced risk management and teach you why you need to care about risk management and how it's going to be different for every pair that you are going to be trading. So make it your mission to watch this entire video. Otherwise, believe me when I say the information that you will learn will be incomplete, making it much more difficult to apply to your actual trading. But before we go ahead and break down risk management properly, it's important for everyone to know, why should you even care? Why should you even care about risk management? Well, I'm going to answer that question with 4 points. Point number 1, best strategy can still make you lose. You can have the best strategy in the world when it comes to your trading. You can have the best trading style. But if you don't know how to manage your risk properly, and if you are not disciplined, even having access to the best strategy in the world can result in major losses. Number 2, you might be working for days and weeks and months to grow your trading account. But if you don't know risk management properly, a few bad trades can blow your entire account. It only takes a few bad trades. It only takes one bad trade, for that matter, for you to lose your entire capital. So you need to know how to manage your risk properly to not be a victim of these markets. Number 3, hard-earned money. For us who are investing our own capital into these markets, chances are this money has been made elsewhere. So it doesn't make sense for you to work somewhere, make that money, and invest this money in the financial markets without knowing how to manage your risk properly. So you need to know how to protect your capital. And number 4 is gambling versus investing. This is the major difference between gamblers and investors. Gamblers do not care about risk. Oftentimes they risk however much they want to, however much they have in their pockets if they're not disciplined, right? Whereas investors, we need to manage our risk. So if you don't know how to manage your risk properly, you're not an investor, you're not a trader, you're a gambler. And this will be the downfall of your trading journey. So first, let's speak about some typical things that have always been taught when it comes to risk management. Generally speaking, you have always heard and you have always been taught to risk 1 to 3% of your capital. That is completely true. However, it could be looked at as an incomplete statement, because saying 1 to 3% of your capital might not necessarily apply to everyone. You have to always risk however much you are willing to lose. And oftentimes when your trading account grows to multiple 6 and 7 figures, you don't even need 1 to 3% risk anymore. You can bring that down to 0.5%, 0.25%, and so on and so forth. Another thing that people are always generally taught is, for every $100 in your trading account, use the lot size 0.01. So 0.01 per every $100 or £100 in your trading account. Now, this is also extremely misleading and also very false. And we will be speaking about this properly a little bit later on, because this number is going to be very different depending on the different pairs that you trade, which will in fact have a major impact on your risk management. Now, generally speaking, 2% risk could be acceptable. However, you should always remember to risk however much you are willing to lose. You are the only person that's in control of your trading capital in these markets, and you are in full control of your risk. So you should always risk however much you are personally willing to lose. Now, before we move on to the exact risk management and the lot sizes aspects of things, let's break down what we mean by 2% risk. 2% risk on $1,000 account, or £1,000 account rather, it simply means your risk is £20. As simple as that. So when we say risk 2%, we are talking about 2% of your trading capital, 2% of your account balance. So in this specific case, 2% risk of £1,000 or 2% of £1,000 is going to be £20. So risk £20. However, something that is also always taught is 2% risk per trade. Again, unfortunately, this is also a misleading statement because it shouldn't be 2% risk per trade. It should be 2% risk per every pair you trade. If you're trading GBP USD, you should not look to execute, for example, 2 positions with 2% risk each. That's a big no-no, okay? Instead, if you're trading GBP USD with 2 positions, you should trade that with 1% risk each, which will result in a total of 2% on your account. So always think to yourself, what currency pair am I trading? Okay, I'm trading, for example, Euro versus the Japanese yen. And you want to risk 2% of your capital on that specific trade scenario that you have. If you're executing 1 position, then you can do 2% risk on that 1 position. If you want to twin trade it and have multiple positions on the same pair, then you have to make sure you divide your risk to always keep it to 2% per every pair that you trade. Now, I'm just using 2% as an example here. As I said, this number could vary depending on you, depending on how much you are willing to lose. But you know the general guidelines that's always taught when it comes to trading. So what I want to actually go ahead and speak about a little bit right now is lot sizes, because I believe this is something that a lot of people are still confused about. Now, it goes without saying, lot sizes can be different depending on your broker and depending on the asset classes that you trade. Because of the different contract sizes, your lot sizes may be different. So what I'm going to be speaking about in this video will generally apply to the main 28 pairs that we trade, which derives from the 8 major currencies. And the 8 major currencies, as you know, US dollar, Canadian dollar, Australian dollar, New Zealand dollar, Swiss franc, euro, pound, and Japanese yen. So the 28 currency pairs that derives from these 8 currencies, and this risk management applies to this. Amazing. Major, not major, major. Now, please do fact check this for yourself, for your specific broker, to make sure that the information we're given does indeed apply to you. But the gist of it is still the same. The percentage of it will be the same, and most likely some of the calculations will be the same. But you have to always double check this for yourself before any execution. When it comes to lot sizes, you have different names for different lots. Let's say it's starting from the micro lot, which is a 0.01. When you open your MetaTrader 4 and you want to execute a position, on the top, it normally says a number. That number, the lowest it goes, oftentimes is 0.01. Then it's a mini lot, which is a 0.1, and a standard lot, which is a 1.0. We are generally taught that a 0.01 is 10 cents per pip, or a 0.1 is $1 per pip. This is also wrong. This is also misleading. The value per pip depends on the currency pair that you are trading. And this is where the real source is going to kick in. So if you're not taking notes, I recommend start to take notes right now. So consider this. I'm going to do it in a different color, make it a little bit easier to see. Consider the pair AAA BBB. So this is the currency pair that you want to go ahead and trade. Your earnings and your losses, so earnings and losses are in terms of BBB. It's going to be in terms of the second currency within the pair that you are looking at. So if you have your account size in British pounds, and if you're trading, for example, euro versus Canadian dollar, your earnings and losses are calculated in terms of Canadian dollars, not British pounds. They are then exchanged to British pounds, and that's why you see the number in GBP. But your earnings and losses are calculated in terms of Canadian dollar, okay? So a 0.1 position, for example, a 0.1 position, instead of it being $1 a pip, is 1 unit of BBB per pip. So the example for this could be, let's say, again, I'm going to use EuroCAD. A 0.1 position on EuroCAD is equal to 1 Canadian dollar per pip. As simple as that. I'm going to give a few more examples on this before we move on, just to help you with better understanding, because I do believe that this is probably something that not a lot of people are familiar with when it comes to risk management, when it comes to calculating your risk. So, example, we'll give a few examples. We'll go through a few different ones. Let's say you are trading euro versus the British pound. So you're trading euro GBP. For a 0.01, your earning is going to be 10p per pip. For a 0.1, your earnings or losses are going to be £1 per pip. Remember, we calculated based on the second currency within the pair. In this case, the second currency is British pound. A 1.0 will be £10 per pip. On the other hand, let's say you are trading Australian dollar versus the New Zealand dollar, right? If you're trading Australian dollar versus the New Zealand dollar, your earnings and losses are going to be in terms of New Zealand dollars, meaning what? A 0.01 position is going to be 10 New Zealand dollar cents per pip. 0.1 position is going to be 1 New Zealand dollar per pip. And a 1.0 is going to equate to 10 New Zealand dollar per pip. Another example. Let's look at euro versus the Swiss franc. So the second currency in this pair is CHF. A 0.01 position, again, it's not the same as 10 cents or 10 pence or 10 pennies every single pip. This is the same as 10 rappen per every pip, or in other words, a tenth of a Swiss franc. The 0.1 position will be 1 Swiss franc per pip, and a 1.0 is going to be 10 Swiss franc per pip. I can go on and on and on about different examples, but the last example that I'll give in this specific scenario is a Japanese yen example, because for Japanese yen, it's slightly different. And the reason why it's different for Japanese yen is for all of those 8 currencies that we looked at, when you look at all of the 7 currencies, apart from Japanese yen, or the other 7, the base units is always 1, €1, £1, £1 Australian dollar, 1 New Zealand dollar, 1 Swiss franc, 1 US dollar, so on and so forth. When it comes to Japanese yen, the base unit is 100. So this makes calculations slightly different, but we're going to use this GBP JPY for this specific example. Let's say you're trading GBP JPY. A 0.01 is going to be 10 Japanese yen per pip. A 0.1 is going to be 100 Japanese yen per pip. And a 1.0 is going to be 1,000 Japanese yen per pip. Now, some of you may be looking at this thinking, oh my God, I did not think this was this confusing. What's going on? These numbers are all over the place. What do these even mean? Don't worry. This will fall into place. I just want you to understand the concept that lot sizes, earnings and losses for those lot sizes can be different depending on the pair that you are looking at. It is always calculated based on the second currency within the pair that you are trading. So it's crucial to know how to manage your risk properly. Otherwise, your risk will always be inconsistent. So let's have a look at 2 actual trading scenarios. And this will probably be a good and easy way to break down kind of the differences in between these scenarios as well. So let's say you are trading AUD/NZD. So you're trading Australian dollar versus the New Zealand dollar, and you have executed a 0.1 position and you have caught 100 pips. 0.1 is 1 New Zealand dollar per pip. So 1 times 100, you've made 100 New Zealand dollars in this specific trade. In another scenario, you're trading euro versus the British pounds. You also executed a 0.1 position, which is 1 British pound per pip. You have also caught 100 pips trading euro GBP. Again, 1 times 100 equals 100, but it's a whole different currency base. It's British pounds. And here's the thing. You've used the same lot size. You've caught the same number of pips, but in one scenario, you've made 100 New Zealand dollar. In the other scenario, you've made 100 British pounds. And this is crazy because 100 New Zealand dollar is almost 51 British pounds. So it's worth almost half of the earnings for your other trading scenario, being the Euro GBP example. So when you look at risk management from this perspective, you'll start to understand that not only you have to pay very close attention to how many pips you are risking and what lot size you need to execute and what trade you're taking and so on and so forth, you also have to pay very close attention to what currency pair you are trading, because that will indeed affect your risk. So let's start to little by little get to the real source, which is how to calculate your risk. So assume this specific formula. Let's say we are looking at lot size equals, and if you don't like maths and numbers, don't worry, it's a lot easier than you think. Lot size equals monetary risk divided by stop loss in terms of pips multiplied by 10. Now I'm going to write it over here. This is incomplete. Okay, so it's incomplete. I don't want anyone to quickly screenshot this and get off the video because you're going to miss out on the important bit of this formula, okay? So this is incomplete, but generally speaking, just assume this formula for now. And when we say monetary risk, that monetary risk is to be calculated in terms of the base units rather than the subunits, okay? So no pennies, no cents, the actual base units. And the stop loss to be calculated in terms of pips. So let's have a look at a few different examples when it comes to this specific formula. Example 1, your balance is £1,000. Your risk is 2%, which is £20 of your trading account. So you wanna trade, and now your risk is gonna be £20 because you wanna risk 2% of your £1,000 trading account. Your stop loss in terms of pips is 20 pips. So if we go ahead and put all of these numbers in the formula, your monetary risk is £20. So 20 divided by stop loss in terms of pips times 10. So your stop loss in pips is 20 multiplied by 10. And when you calculate this, this gives you a value of 0.1. This is your lot size. Let's have a look at another example. Same balance, same percentage risk, so same monetary risk. In this case, let's say your stop loss instead of 20 pips is 50 pips. So in this formula, the monetary risk stays the same. However, instead of it being 20 pips in stop loss, it will be 50 pips, so 20 divided by 50 times 10, which means your lot size will change from a 0.1 to a 0.04. So you're risking the same percentage on your account, but because there's a different number of pips, you have to adjust your lot size. Now, I mentioned that this is incomplete. It's a very easy way to calculate it, but as I mentioned, this is incomplete because it does not account for literally what we spoke about earlier, which is what pair are you actually trading? So this does not account for this. So how do we solve this issue? Simple. There are two ways. Number one, you can use a calculator that's very easily and freely available, which again, I'm going to go into detail about that a little bit later on. Or number two, you can convert your monetary risk to the BBB currency. So if you're trading euro versus Canadian dollar and your trading account is in terms of, for example, British pounds, then you can go ahead and convert your monetary risk, your £20, into Canadian dollars, and then put the numbers in this formula. Simple as that. So, example, let's say you're trading NZD CAD. And again, same thing. Your balance is 1,000. Your risk is 2%, which is £20. And in this case, let's say your stop loss is 30 pips. Here's the thing. A lot of you might be thinking, hang on a second, this is way too much calculation. And how am I meant to change this from, for example, British pound to Canadian dollar? You know, first of all, it's a very quick Google search, or you can just use your Alexa or Siri or whatever. Actually, for that matter, hey Siri, how much is £20 in Canadian dollars?
£20 is 34 Canadian dollars and 22 cents.
34.22, right? Our risk, although it's £20, £20 is the same as 34 Canadian dollars and 22 cents. So if I want to now go ahead and put all of these numbers in the formula that we spoke about a little bit earlier, instead of putting £20, I will put the same value for that £20 in terms of Canadian dollars. Why? Because Canadian dollars is the second currency in the pair that I'm trading. As simple as that. So now I can go ahead and use this information to apply this to the formula, and it will be as simple as this. I'm going to just use 34 instead of 34.22 for the purposes of this video, but I don't recommend necessarily changing the numbers as you're calculating it, but it will be monetary risk over the number of pips for your stop loss multiplied by 10, which will give us around a 0.11 lot size. So now you are also taking into account what currency pair are you trading. Taking into account what currency pair you're trading, what is the second currency, exchanging your monetary risk from your specific currency to the second currency of the currency pair that you're trading, and calculating it this way. I'm going to give another quick example as well. Let's say instead of NZD CAD, you are trading. Let's do the Japanese yen example, actually, since we spoke about Japanese yen. So let's say you're trading Japanese yen. In the Japanese yen examples, you have to divide the final number by 100. So whenever we get to this final lot size, we have to go ahead and divide that by 100 to get the correct value for our risk. Remember, we said the Japanese yen is slightly different, right? So same balance, £1,000, same percentage risk, £20 or 2% risk. In this case, instead of 30 pips, let's say 40 pips is the risk. Let's do the same thing. Hey Siri, how much is £20 in Japanese yen?
£20 is 2,731 Japanese yen.
2,731 Japanese yen. Again, simple as that. We just put that in the formula. Monetary risk divided by how many pips is my stop loss? 40 times 10. And if I go ahead and do this calculation, it will come out as 6.8275. Now, as I mentioned, you have to divide this by 100, which the lot size will roughly be around a 0.06. So if you want to round it up, which I don't recommend, I always say round it down, it will be a 0.07. So that is now the correct lot size to go ahead and execute for this specific scenario where you're taking into account what currency pair you are actually trading. This is how you keep your risk consistent to 2% on every single trade that you execute. Now, it may look like it takes an extremely long time to calculate your risk, but in reality, when you do it often, you will get used to it. And before executing trades, you will naturally find yourself knowing exactly kind of what risk you need to get into, or what lot size rather you need to kind of execute for that specific trade. So I don't want anyone to worry about exactly how you're meant to quickly do these calculations, because the good news is that there is actually a calculator that will do this for you, and this is called the Myfxbook calculator. So if you literally go on Google and you search for position size calculator, it will come up with the Myfxbook website for your calculator, where in this specific calculator, it will ask you what's your account currency, and then it will ask for your account size, percentage of risk, which obviously, it should be 1 to 3% or however much you want to risk. You can also change that to actual monetary risk. So you can say, okay, I want to risk, for example, £10 or £20 or £100 or $1 million or whatever. It will also ask you how many pips is your stop loss. Then it will ask you about your contract size, which I'm not going to speak too much about contract size right now. That's going to be a whole video on it in itself if I want to speak about contract sizes and what they mean and what they are and how that can potentially relate to other things. But it will ask for your contract size. Now, generally speaking, if you're trading the major 28 pairs that we spoke about, not the major pairs, but the 28 currency pairs that we spoke about coming from the major 8 currencies, then your contract size oftentimes will be 100,000. It should always be at 100,000, but it's a very easy way to check it on your MetaTrader 4, where you can click on a pair and click on details, and you can check your contract size over there. So as soon as you click on a currency pair on your MetaTrader 4 and click on details or information or whatever else it might say, it will give you what contract size is for that currency pair rather. And oftentimes you'll find this at 100,000. Now, again, when it comes to Myfxbook calculator, I have to mention this, that it really does matter kind of what broker you are with, because this is a calculator and it's hard to generalize this to every single broker out there. It's impossible actually to generalize it to every single broker to satisfy every single contract size or whatever else it may be. So sometimes this calculator will be wrong if you're trying to calculate your risk, especially for other assets such as precious metals or such as, let's say, exotic pairs. So always triple check the information for yourself. After that, it will ask for what pair you are trading, and then you press on calculate and done. It will give you your lot size there and then. Feel free to try this on your own. Definitely use this. To this day, I use this calculator before I execute any of my own positions. So again, Myfxbook calculator, position size calculator, giving the information that it requires, and simply click on calculate. But again, always use your common sense when it comes to risk as well. I'm going to write this over here. Use your common sense. What I mean by that is if you put in the values and all of a sudden it gives you, for example, a lot size of 20.0 and your trading account is only, for example, at £1,000, then clearly something is wrong there. Unless your stop loss is extremely small, there's something wrong there. So your lot sizes should always be similar to the lot sizes that you have previously executed and somewhere around the norm for your specific trading account. This kind of does bring our video to a conclusion because we have now not only spoken about what risk is, why you should care about it, how it's different for different pairs, and how you can calculate it through a formula for yourself, or simply using Myfxbook calculator to calculate your risk. But I also want to speak a little bit about trading psychology as well. I'm not going to go into too much detail about it because you can literally just go and watch my trading psychology video. I'll leave the link in the description. But a bad psychology will lead to bad risk management, which will lead to potentially a blown account. So you have to always make sure you are in control of your psychology. And even if you go through, for example, a losing period where you're losing a few trades, or maybe for a week or 2 weeks or even a month, you might have a losing streak. You always have to keep your risk consistent. Don't increase it. That's where gambling kind of kicks in. Instead of investing, you're now gambling. So do make sure to grow your psychology at the same time so it does not affect your actual risk. But with that being said, that's it. That's all when it comes to risk management. Now you know not only what risk management is and why it's different for different currency pairs that you trade, but now you also have a formula on how to calculate it and have access to a calculator that can do it for you. Just make sure you do it. Don't think to yourself, oh, it's okay, I'm just going to execute this lot size for my trading account. Don't make that mistake. You're trying to create wealth. So treat this like a business. Treat it like what it is. And if it is a business, you need to be calculated with the risks that you are taking. So if you have enjoyed this video, do make sure to like down below. If you're new to the channel, make sure to press the subscribe button and turn on post notifications. Welcome to the family. I appreciate everyone's support as well. Thank you very much for all the messages that's coming in on Instagram and all the comments. I see people's trading games elevating. So I'm glad that you are utilizing the information that we are sharing in these videos, in this channel. But do make sure to put the hours in, do make sure to keep everything consistent, and also do make sure to learn how to manage your risk properly for your specific broker, for your specific trading account. But with that being said, I wish you all the best in your trading journey. Take care and let's catch some pips.